Welcome back. Today we're going deep on Antero Midstream, ticker AM. Now this is a company right at the heart of America's natural gas system, and it has just made a massive company-defining bet that could really change everything for them. So let's break it down.
So, you might be asking, why are we talking about these guys right now? Well, it's because of this number right here, 271%. That is the stock's return in just the last 3 years. I mean, to put that into perspective, that's the kind of performance that really makes you stop and ask a pretty big question.
And that's really the core question we're digging into today. After a run like that and a major strategic pivot, is there any juice left to squeeze? To figure that out, we have to get our heads around how the company's entire strategy has just been completely turned on its head.
Okay, first things first. To understand where Antero Midstream is headed, we absolutely have to understand how they make their money. It's a business model that, on the surface, is beautifully simple. But, as you'll see, it's also surprisingly risky.
The easiest way to think about it is like this. Antero Midstream is basically a toll road for natural gas. See, they don't actually drill for the gas and they don't sell it to you and me. Nope, they own the stuff in the middle, the essential infrastructure, the pipelines, the compressors, everything that moves the gas from the wellhead out to the major markets. And for every little bit of gas that passes through their system, they collect a fee. Simple as that.
And their business is actually a bit more than just pipelines. It's really a three-step process. First, they've got to gather all that gas from thousands of different wells. Then, they use these huge compressor stations to jack up the pressure so the gas can travel hundreds of miles. And, this is a big one, they also have to process the enormous amounts of water that come up with the gas during drilling. Every single one of those steps is a service they get to charge for.
Now this whole model creates this incredibly stable, super predictable stream of cash. Why? Because they get paid based on the volume of gas moving through their pipes, not its crazy volatile price. So they have a really clear picture of what their future revenue is going to look like. It's a fantastic business model, in theory, but it has one giant, glaring weakness. Nearly 100% of that gas comes from just one single customer, its own parent company, Antero Resources.
And you know what? That single customer risk is the perfect setup for the biggest thing that happened this past quarter. A truly transformational deal that completely reshaped the company. We're calling it the Big Appalachian Shuffle.
And get this, management moved at lightning speed on this thing. I mean, this was a complex two-part deal announced back in December, and they managed to close both the acquisition and the sale of their other assets in just 2 months. For a deal this big, that is incredibly fast.
The strategy here was a classic sell high, buy low. It's brilliant, really. They sold off their older, low-growth assets in Ohio for a fantastic price. We're talking over 11 times what those assets were earning. Then they immediately turned around and bought a whole set of high-growth assets right in their backyard for a much, much cheaper valuation, around 7.5 times earnings. So they basically swapped a stagnant, sleepy asset for one with over 400 new pre-approved well sites ready to go. And the immediate result? What's the punchline of this whole shuffle? A projected jump of 15% or more in their free cash flow. And just to be clear, that's the real cash left over after all the bills are paid. Cash they can use to pay down debt, reinvest, or give back to shareholders. And it's happening pretty much right away. So this huge strategic move completely changes the story for this company. It really sets up a very clear, very interesting debate between the bulls and the bears.
All right, let's start with the bull case. It's pretty straightforward, actually. The argument is that by getting rid of those slow-growth assets and doubling down on their core, high-growth area, Antero Midstream has basically engineered a transformation. It's not the same company it was last year. It's now a pure-play growth engine.
And you don't have to take my word for it. The company's own guidance backs this all up. For 2026, they're forecasting 8% growth in EBITDA. That's basically their core profit. And an even better 11% growth in free cash flow, and that's after paying out their hefty dividend. This isn't some far-off promise. This is real, tangible growth that's happening now.
And what's really wild is that this growth isn't just a flash in the pan. I mean, look at this chart. It shows this remarkable consistency. If they hit their targets this year, it will be their 11th straight year of growing EBITDA since they went public. That kind of track record, that's almost unheard of in the energy business.
Okay, but hold on a second. The story isn't quite that simple. The bear case argues that by streamlining the business and focusing it, they've also made the risks much, much bigger. It all really boils down to one single word: concentration.
This visual right here is the heart of the entire bear case. That whole circle, that's all of Antero Midstream's revenue. And as you can see, 100% of it comes from one single customer, Antero Resources. So if the parent company even sneezes, Antero Midstream catches a cold. There is literally zero customer diversification.
So for the bears, the conclusion is pretty clear. This big strategic deal, well, it came with a whole new set of risks. First, they took on more debt, more leverage to get it done. Second, you have to ask, after that massive 271% run, is all the good news already baked into the stock price? Third, they're still tied to the whims of natural gas prices, just indirectly through their only customer. And finally, for you income investors out there, that dividend, while nice, isn't growing.
So, with these two really compelling arguments, what are the key signals we should be looking for? What's going to tell us if the bulls or the bears have it right? Let's put together a quick scorecard for the rest of the year.
Okay, here's what you need to keep on your radar. First, and this is by far the most important, you have to watch the production volumes from their parent company. That is the fuel for this entire engine. Second, keep an eye on their debt levels. Are they actually using all that new cash flow to pay down that debt quickly? Third, they used a short-term bridge loan for the deal. The interest rate they get when they refinance that into long-term debt is going to be absolutely critical. And finally, watch Wall Street. Right now, the analyst consensus is basically a hold. If you start seeing that shift to buy, it could signal a huge change in how people are thinking about this stock.
Look, this was a bold, decisive move. No question about it. But the real question now is, was it the right one? Did they just pull off the perfect value swap, selling a lazy old asset to buy a high-octane growth machine? Or, in concentrating their business so much, did they just trade one set of manageable risks for another, much more dangerous one? I guess the next few quarters are going to give us the answer. That wraps up today's deep dive on Antero Midstream. Drop your questions and takes in the comments. We read every single one.